Okay, we've got 45 minutes and a lot of slides and a lot of material to go through. Essentially, we're going to be talking about two different types of portfolios. Those that we're using the futures markets, combining them together, kind of show you a process that we can go through. It's got nothing to do with technical, it's just putting together individual markets, combining them together. And then the second part of the presentation, we're going to focus on taking individual systems applied to those markets and bring them all together. So I just like people to kind of know what it is that we're going to be talking about. Here's the disclaimer that everyone must read before we can go forward. Show of hands, we've all read it? Very good. All right, so this is essentially what we're going to be talking about. Diversification is the word of the day. You can keep a running tally on how many times I use some form of diversification. It'll be probably upwards of about 100 or so. But it's important because we're going to be looking at lots of different markets, lots of different systems, and an appropriate way to actually trade specifically on the future side. I'm a past CTA. We're building a fund right now. I am 100% systematic in my style, so everything that I work on is going to be on the future side. Specifically, we're going to be looking at crude oil. We're going to be looking at the S&P. We'll be looking at the euro, gold, and one more, and the 10 years. And so we're going to be looking at 5 different markets, 5 different sectors. And the ultimate goal that I just want you to know, it's very simple, but I've done a number of presentations for the expo and for TradeStation, for other people as well, from the novice to the really sophisticated investors. But one thing when I'm dealing with this type of a show, a lot of people like to focus almost exclusively on a single market, whether it's the S&P or the 10 years or the euro. And what I want you to understand is that when you trade, when you look at the markets and you're building a portfolio and you're allocating monies for real trading, you want to focus on having as many markets as you possibly can. You want to diversify. You want to have as many markets, as many systems as you possibly can handle based upon the dollar amount that you have at your disposal. So you may start off just trading a single market, and you may say, I want to then incorporate more and more styles, which would give you a type of diversification. But what I would encourage you to do is to look at sort of horizontal diversification across different markets. So the first step to the presentation is we're going to identify some of these markets to trade. We're going to review boring but important correlation studies, give you some different portfolio allocation models at the very end so you can see how some of this stuff actually does work. We'll review some performance metrics. And then the second part is that's where we're going to combine some of these things together into smaller portfolios, what we term as baskets, and then those baskets into a larger portfolio based upon different trading styles. So there's lots of layers to what you can do. And the important element here is no matter what dollar amount you're trading, no matter what markets you're trading, always try to take it to the next level. The goal is do not be a one-trick pony. Do not simply trade a single market with a single system and think that this is where you're going to end. That is only the beginning. More markets, more systems, more diversification. What you'll find when we get into some of the performance metrics, that's where you'll see the real advantage to diversifying across all these different markets. So if anybody has any questions along the way, show of hands. We'll try to address everything that we can. If we have time at the end, I'll show you our free website where we have a lot of material on it so that everything that I show you today, a lot of it is available for free up on the website so you can sort of keep tabs, not only in the 5 markets that I trade or that we monitor with our trading, but also some other markets as well so that you can get a broad scope as to what you can do ultimately to improve your trading. So the markets in general that I would suggest that you at least focus on. And again, I said that I've been a CTA, commodity trading advisor in the past. I've traded 40 different markets, all on the future side. Here's a smattering of some of the ones that you might want to look at. These are some of the more liquid markets. I've specifically selected them because they're some of the easier markets to trade. There are easy and there are hard markets depending upon the style. But the point being is that if you're going to look at certain markets like corn as an example or wheat, You could also trade rough rice. It's not the easiest market, not the most liquid market. So if you're going to broaden your portfolio and look for other markets, these would be some of the ones that you'd want to focus on. Now, this is somewhat dated material because we had to put our slides in a while ago. So this came back sometime mid to late May, I believe. And some of the charts that we put up here are just going to show you the performance on a year-to-date basis for some of the different markets that are out there. So if some of you are unfamiliar with soybeans and you say, well, that's just for farmers, well, there's good money to be had trading soybeans. It's a top market at this point. It's come off a little bit since. Bean meal, very good. The German DAX has done well. S&P and any of the ones that are in red, those are the ones that we're going to be focusing on. The ones that are in blue are the ones that are making money, while the ones that are in, I guess that's gold, are those that were losing money. So at the time, and we know that the S&P has come down and been pretty volatile at the time, as of May 18th, S&P at that time was up 4.37, call it 4%. 10-year notes up 1.25. Gold virtually flat, nothing for the year. Euro was actually down, and crude oil was down almost 8 points, or 8%. Point is that because we trade on the commodity side, the future side, you can make money if the market goes up by going long. You can make money if the market goes down by shorting. So the fact that some of these markets are on the negative side is not necessarily a bad thing because we can take advantage of it. This is one more component to how we can develop a really good and strong and diversified portfolio, long and short. So I just want to show you at least some of the performance so you can get a really good perspective as to the kind of monies that can be made in certain markets. Obviously, these things change obviously on a regular basis. So if anybody needs up-to-date information, at the end of the presentation, I'll give you my contact information. You can sort of keep tabs as to which ones are doing well, which ones are doing poorly based upon lots of different time frames. Correlation. It's boring. Nobody wants to talk about correlation, but it actually is important. It's important how it's constructed. It's important how you use it. It's important how you use that information in the construction of a portfolio. So I know it's pretty basic and most people know it, but just in case, correlation of +1 means that things are highly correlated. They move almost in lockstep. If it's a negative correlation, it means that they're inversely related to one another. Just the important thing, because when we start looking at some of these charts, I just want to make sure that you're aware of it. And then the other thing is that there are lots of different ways in which you can do correlations. It's very important that if you ever look at a correlation chart or you develop your own correlation chart, as you can inside of TradeStation, the platform, what you want to do is instead of using price action, which is what most people gravitate towards, what you want to do is you want to use percent return figures. You normalize things, it gives you a much better correlation formula, and the numbers are different than what you would if you were using price action. So it's very important that if you're going to do some of these types of correlation matrices that I'm going to be showing you, that you want to make sure that you understand that you're doing it in a percent mode. There's a lot of people, I don't know why, but they seem to gravitate towards the price action. And the reality is that when you're doing this type of analyses, you want to focus on percentage. So that's the basic stuff. This is a graphic that we create on a weekly basis. So a lot of the stuff that you're going to be seeing, if ever you want to see up-to-date information, it'll be up there on the CapitalLogix website. And it's fairly straightforward, but a little bit different for what most people would be looking at. One, most people think that correlation maintains itself. If the correlation between two markets was 0.95, highly correlated, it doesn't necessarily mean that they're always correlated. These correlation numbers are forever adjusting themselves. And because of that, you want to be able to maintain sort of an idea as to what's been happening. And you also want to have things known from a relative perspective. Are they high or are they low relative to where they've been in the past? So and just simply saying that the correlation between, in this particular case, the S&P and the euro, the correlation in the lower portion there says it is at 0.72. Is that high? Is it low? Is it consistent? This chart, what it shows is a 24-month rolling correlation. I wish I'd brought a laser pointer so I can actually show, but any point on that dark blue line, that's one point, and that goes back 24 months. So that 24-month period will show you specifically how it adjusts over time. Thank you, Stan. It'll show you how the correlation adjusts itself over time, so you can get an idea as to whether or not something is stable or if it's fairly erratic. And you
at a point 4, well, let's say this month,
mm-hmm.
you would go back, that would be a point 4 higher than what it was 24 months ago. Is that right?
Not point 4. What it would be is right now, this is the end of the chart. So on May 12th when I ran this, the correlation between the S&P and the euro was 0.72. But you can see from this that if we had gone back to, we'll use an extreme here, back in March of 03, that the correlation going back 24 months between the S&P and the euro was, we'll call it negative 0.3. So the point being is that do not assume that if two markets at this point in time are highly correlated, that they always maintain a high correlation, that the correlation is a moving, it's a breathing entity, it's dynamic, it's changing all the time. And this is on monthly. I'll show you weekly as well. All this information we put up onto the site on a weekly basis. So I guess the point is that if you were designing a portfolio right now, and these numbers don't adjust too much, they're very slow moving, but if you were to be developing a portfolio right now and you said, hey, I want diversification, I'm an S&P trader, and I want to now take into account another market, well, the euro may not necessarily be that market because it has a high correlation. If one goes up, the other one will go up. And so what you're trying to do is to literally focus on the yellow line. What you're looking for in general terms, you're looking for a near zero correlation. There are times where you actually want a negative correlation as well, but in a perfect, very generic bullet point, if you were to look at those markets that are in and around the zero correlation and you're building out your portfolio, I am an S&P trader. I now want to take some of the money that I've been making in the S&P and I want to put it towards another market. What market are you going to invest in? Well, the euro may not necessarily be that market right now because, one, it's high, with the correlation being 0.72 at the present time, plus you can see that it's been trending up as of late. What you probably want to be doing is focusing on some other markets as well. So the nice thing about this chart, one, it shows that correlation changes over time. That's obvious. It also shows you relative to itself what is considered to be a high correlation and a low correlation. I lost my battery on here, so the bottom blue line, the light blue line, that represents low correlation between the two. If you're at the upper portion of of course they're both light blue lines, but the upper light blue line, that represents high correlation. So you can see that at certain times over the period of this analysis that the correlation obviously adjusts itself. Second, that at certain periods like in 03, March of 03, it was considered to be a low correlation. You look at spikes in March of 05, thereabouts, that the market was at a high correlation. You look at it today, it's at a high correlation. It adjusts itself all the time. Question? There we go. Genius. I should be using the mouse. So, yes. All right. So here we have, a high correlation with that line, and you can see that at the present time we're obviously in a high correlation phase. So this information, as you build out your portfolio, what you want to do is you want to say, if I am a trader that is trading market X, what other markets could I be looking at, obviously, to be able to have an opportunity to make money in both markets with different styles of trade, but not necessarily have them work in lockstep with one another. That's the basic point. Question? Is that basically a price channel or a Thompson channel? What that is, it's a good point. Some people think they're Bollinger Bands. What they are is, this is done inside of Excel. So what we do is we look at the top 95 percentile and the bottom 0.5 or 5% percentile. And what we're doing is we're looking at a look-back period again of 24 months. So it's forever adjusting itself. And what it's doing is the light blue lines, and both the high and the low, what they're attempting to do is dynamically say, in this environment, going back in time, what is considered to be high or low correlation. It's important because you'll see with some markets, and I'll show you lots of charts on correlation. Hopefully it'll be a little more exciting. But what you'll see is that these things adjust themselves, and these upper light blue and lower blue lines, they really help to give you some guidelines so that you're not doing this. I took a stats class in high school, and I know that a correlation of 0.85 is considered to be high. The markets are forever changing, hence the reason we have that dynamic level. The light blue lines are dynamically changing to let you know in this environment at this particular time, this is considered to be a high or a low correlation. So don't think in terms of what the actual number is. Obviously you want to know what it is, but don't think in terms that it is high or low based upon its number now. Think in terms that you want to know what is it relative to the past, key number or key chart. Here's another one where we're looking at the S&P, same setup, but it's the S&P versus the 10-year notes. I want you to realize that with the yellow line, again, in around the 0 mark, well, actually, it was supposed to be at 0. It looks like it moved. I gave my charts to somebody, and they adjusted them, I think. It's supposed to be at the 0 mark. And what I want to do is to make the point that obviously right now the correlation itself is low. It's at negative 0.58, and it is one that spends the vast majority of its time either at the 0 mark, which is not placed properly, or it is it's below the 0 mark. But you can see that it goes up and touches, up and touches, up and touches the 0 mark, and then deviates from there. Not that this is trading in any way, shape, or form, but what it is going to show you is that in comparison to what we saw with the euro, while the euro is very, very high and had been high for a while, this one has been able to maintain itself near the 0 level. And right now it's considered to be extremely low and starting to come back from it, but extremely low based on the lower blue line. So
therefore, if you're going to trade the S&P 500, you would want to find something other than the 10-year note to try and make that 0.
You would want to approach that for the portfolio, but the point that I'm making is that when you start looking at the arsenal of markets, let's just make the assumption that you're an S&P trader. Show of hands, how many people trade the S&P? Okay, so the vast majority, well, from what I can see, a large portion of you guys trade the S&P 500. If you want to sit there and say, now I want to start to broaden this, I want to start looking at some other markets, would you be trading the euro, which was 0.72 and very high, or would you be looking at something like the 10-year notes, which had a negative 0.58? It is very low right now, but it gravitates towards 0. I would say, if I were a betting man, I would want to have the 10-year notes in there versus the euro at the present time. So think of it as a ranking of potential investments or potential markets that you'd want to invest in. Which ones would I want to gravitate towards? I'm going to spend the time, I'm a systems trader, so I'm going to develop systems for those markets. I much rather find the market that is 0 or near 0 correlated versus one that's highly correlated at present. The question is, for they're recording and doing the audio, the question is, would I rather have a market that is at a high correlation? No. Or would I rather have one that has a low correlation right now on the 10 years? It is extremely low and likely to come back to 0. And the answer is yes. One that is low and likely to return to quote-unquote normal stage, 0, would be a market that I would probably want to incorporate into my portfolio first, rather than the one that's already high. So just looking at some of these other markets, just to give some perspective, this is S&P versus crude oil, and you can see at present time, similar to the euro, that it's high. It's moving from the high to lower points, but it is still considered quite high. It's 0.73 for the crude oil, 0.72 for the euro. Probably not the market to be trading at this time if one were to incorporate another market. Gold. A lot of people like gold. We like it because it actually has a nice decorrelation, stabilizing ability for your portfolio. What I want you to realize in this case is, one, you can see that it stays in around the 0 mark quite a bit. this spread, Bollinger Bands. We all know Bollinger Bands. Think of the light blue lines as being Bollinger Bands. You can see that they're pretty tight right now. And you can see that historically, they don't deviate that much, as we saw with the euro. This will be a key point here in a second. And what I want you to realize is that not only is it low now, it also is relatively stable in around the zero mark as well. So it makes for a good investment. Everyone says, inflationary, deflation, gold's a good investment. This is why they say that. So not a bad market to put into your portfolio for a real reason. Question?
When you say gold, what gold ETFs?
This is gold futures. This is gold traded at the COMEX. But obviously, they all replicate one another fairly closely. So whether it's an ETF that emulates gold itself as opposed to the miners would be a little bit different. But the reality is that you'd want to take a look at the correlation between those markets. But this represents specifically the gold futures. The point being in this graphic is to show you some type of a comparison between what the euro and crude were doing versus what the 10-year and gold are doing. So again, sort of to summarize some of the things we just saw, we have two that are high, being euro and crude. We have one that's very, very low, which is the, in this particular case, gold, 10 years. And then we have one that's got a near zero correlation, which is gold in itself. So these are the 5 markets that we're going to be focusing on. Now, having said all of that, if you're an S&P trader, and this is a chart that we post free of charge up onto the Capital Logics website, and what it does is it will take a market, in this case the S&P, and compare itself against all these other markets and try to summarize all that we just saw in those charts. Let's cut to the chase. Give me a number. What's good? What's bad? So this is what we're doing here. In this particular case, what we do is we call this correlation stability. That blue line, that upper blue line, that lower blue line, how much does it deviate? Does it deviate a lot? Does it deviate a very little? Is it close to zero? What's taking place? Bottom line is that what you have here is the ability to see that the euro, which is CU, the symbol, we got the TY, which is actually pretty high, but it doesn't. It's stable, but it does deviate a little bit. You got crude oil, which is CL, which is low, and then way over on the other side, GC, that's gold. And so you can get a really good feel. The gentleman was talking about some of the grain markets and mentioned something about the meats. It's hard to see it, but else, just a little bit further to the left of gold, we have a couple other markets here. LC and LH, just point that out. That's lean hogs and live cattle. So if one wanted to have another market that they may want to look at, you may want to look at the meat markets. Bottom line is that it just gives you some perspective. Why would I ever trade that kind of a market? Well, the reality is that if you're trying to build a portfolio, and this is obviously the key here, you're trying to diversify your portfolio, you want those markets that offer up good, stable, consistent correlations, hopefully on the low side, which is what this represents, and be able to say, as a starting point, what markets am I going to focus on? So this chart is up there for a lot of the markets that we look at. That market, in this case, the S&P, versus all of the other ones. There's a chart up there. If I'm a 10-year note trader, what other markets could I actually trade? All these numbers adjust themselves, and they all relative 10-year against all the other markets. So no matter what you trade, you can always find something that's going to have a high or a low correlation stability number, lower being better, and put you in a position to have an opportunity to diversify the portfolio. So
Were those all done 24 months?
they were. We do the 24-month and those same charts for the correlation. And this chart, we also do on a weekly basis as well. Obviously, 24 months, 2 years, wow, correlations don't change that much. And so for longer term traders, you'd probably want to look at the monthlies. And then what we do is we translate and do the exact same material. We do it for the weeklies. We don't do anything less than that because from my perspective, the way I like to use it, I want longer term correlations. I don't need to know the minutia. So yes, this is definitely for the 24-month exact same information relative to one another. And then again, if you go up to the site, you can see the same information on the weekly side as well. So these are the 5 markets we're going to focus on. Now, I'm sure that we've all seen this efficient frontier chart at some time in our life, but it's actually pretty cool, and I'm going to show you how you can use it on a real basis, okay? So, boring stuff, I realize. I'm not going to derive any formulas, but I do want to show this. This is a 36-month allocation. So basically mid-May back 3 years. And based upon efficient frontier, basically it's this red dot, the capital market line, the red dot. It's where the blue lines, they have a tangent line to the blue line to the red line. That's quote unquote the optimal, according to this strategy, this portfolio allocation model, that's where the optimal allocation should be. So at the top, what I've done is I've listed the individuals. We've got S&P rated at 22% of the portfolio, and then you can see all the rest of the numbers. You can see that what we're trying to do is to ask this question. Today, going back 36 months, so imagine we're now back 36 months, going forward over that 3-year period, what mixture would have maximized my profitability, i.e. my return, and at the same time minimized my, my risk, which in this case is standard deviation or volatility. And the reason you do that is that if you put all of your eggs in one basket, you are a one-trick pony and you only trade one market, what you'll find is that there are more efficient ways to do this, ways in which you can use this type of a model. So in this case, and I'm going to go through some numbers here, but it'll make the point that you want to, again, diversify. So red dot is really what we're looking at. And if we had done that, if we had that kind of an allocation, you can see that the 10-year notes take up 51, almost 52% of the portfolio. The lion's share, gold, which is that kind of reddish, is only a little over 1%. And you can see the mixture for some of the other ones. And then the 36% CAGR, compounded annual growth rate, just think of it as return, just to the side of it. So gold, 1%. Earlier I said that it had a low correlation. You would think by having that in the mixture, you might want a larger swipe in that, that particular deal. But it's volatile. The market is volatile. The correlation itself is low, but there's a lot of volatility in gold. So even though it had a 16% return, it still only had a very small allocation. So you hear the pundits on TV, gold, gold, gold. There's people here that are talking gold, gold, gold. Just understand that there's a low correlation that doesn't always translate into having a lot of it in your portfolio, whether it's coins, ETFs, or COMEX gold itself on the future side, because of the volatility. So there's layers to this type of analyses. But you can see, had we, and this is the key, had we been back 36 months and gone forward, this is the allocation. Is that practical? Can I use that today? Wow, 36 months ago, I wish I had that information. Well, we're going to get into some ways in which we can look at this thing a little bit differently. So, what you have here is the yellow line represents the S&P 500. The black line represents the portfolio, that allocation I just gave to you. It's kind of a fictitious portfolio because it went back 36 months and we weren't able to actually have that in place. So I'm setting the stage for something. But I just want you to realize that 36 months ago, essentially back to the major pivot low in the market, you could not have found a better time to have invested in the S&P, 100% of your money invested in the S&P versus what I'm going to claim to be a better diversified portfolio. Would you rather make 14, almost 15%, or would you rather make 8%? I'm going to assume without even asking, most people are going to say, I would rather make 15% than 8%. And the reality is, yes, if you had gone back that last 36 months, you would have done better in the S&P than you would have in, quote unquote, my little portfolio. But do remember that that was the perfect time to be in the S&P, and it makes my diversified portfolio harder to compete with it. But during that time period, my portfolio, which made 8%, had a maximum drawdown of only 1%. The S&P during that same time period had a drawdown of 16, we'll call it 16.5%. Well, that's a little bit of pain. Yeah, great to make 14, almost 15%. Everyone would want that. But we often forget about the consequences, the risk-reward type calculations. So I want to point out that it comes at a cost. 16.5% drawdown. UMI, which is underwater mass index. I'm not going to derive it for you. There's an article up on the website if you want to read about it. Think of it as an accumulation of pain and suffering. The higher the number, the more pain and suffering you're experiencing. So the UMI for the portfolio, 3.44. S&P, well, that drawdown was pretty dramatic, and it went on for a while. The accumulation of that pain and suffering put into a number was 118.5%, we'll just round. R squared, the stability of the equity curve. Well, you saw the stability of my portfolio. That was pretty steady. S&P, that's a little erratic. So the R squared, what that does is it's telling you how stable that number is. The higher the number, the more stable it is. The lower the number, the more erratic it is. Quantifying the stuff. We all want to make 15%, but realize that sometimes making less money is better because it's easier. Well, we all just want to make a ton of money, but you'll see in a second why it is that we do that. Question?
Does the time horizon have a big effect with these numbers? So if you're looking at 360 months versus 36?
Yes, and we'll get to that, and I'll show you specifically what's going to happen. So the ratios, Sharp, Sortino, Kalmar, just making the exact same point. I'm going to speed up a little bit because I've got a lot of charts to go through. Now, I said that if you had picked this portfolio, and I said 36 months ago that would be our allocation, that doesn't really help me too much. What we would really be doing is the walk forward concept, where what you're going to do is you're going to use 12 months of allocation right through here. So 12 months as opposed to 36 months, but we're going to get to the 36 months and you'll see that we're going to use 12 months of allocation, figure out what our mixture would be within the portfolio, and use that for a quarter going forward. So we would have our allocation, if I can find my cursor. All right, I'm learning even more here. That's all right, let me just do it here real quick. Okay, so what we'll do is the 12-month allocation, what you're going to do is you're going to get this efficient frontier, the cap M, that number, that red dot that we had on the chart. It will tell you magically what the equation should be and tell you specifically what kind of an allocation you would want. You're then going to use that fixed for 1 quarter. That's what the green represents. Then at the end of that quarter, we're going to rerun and we're going to make some adjustments to our allocation. They'll be refined, minute little refinements, but they are going to change over time. But then we're going to use those numbers for the next quarter. And what we're going to do is we're going to accumulate towards the bottom a walk forward allocation, and so that you can go back in time and make subtle adjustments to your portfolio over time so we can make this much more realistic. I'm going to be giving a presentation on Saturday where I'm going to go into more detail on this, so I just want to at least point this out. Real quick, here's what those quarters would look like, and that last one, quarter one, that's what we had looked at. You can see how the gold does change over time, the red. You can see that the wedge for 10-year notes adjusts big and much smaller. They're refinements to the portfolio, but they're subtle in certain cases and how they adjust themselves, so we can actually get, this is the key, we can actually get an equity curve so we can actually compare the different types of portfolios. So portfolio 1, the 8.3, that's fictitious. I mean, let's be honest. We didn't know what the mixture was 36 months ago. But the WF walk forward portfolio, the return is 7.28. Well, in the real world, yes, everything's going to go down return-wise, and yes, the risk metrics are going to go up because this is the real world. But on a practical, legitimate basis, the returns for the walk forward portfolio is 7.28. The max drawdown is 3%. That's a far cry better than what you would have had just in the S&P 500, again, over the best time frame for the S&P. Wait till we see some other time frames where this doesn't necessarily match up so well for the S&P itself. So all of the numbers, all the ratios essentially are saying the same thing. that the portfolio fictitious versus the walk-forward portfolio reality is essentially the same, but there is some dilution to the performance. Now, I talked about how we're doing this over a 36-month period. Let's just imagine we did it over a 48-month period. You can see that the portfolio, the fictitious, perfect, 7% versus 5.5 for the walk forward. But now, instead of making almost 15% for the S&P, now you're losing 0.74. More to the point, your drawdown, maximum drawdown, goes to almost 50%. Your UMI goes to 865. So what this is essentially saying, I can cherry pick the S&P 500 and say, look, from this point to this point, look how much money you would make. But if you just make subtle adjustments to a non-diversified portfolio, 100% of your money in the S&P 500, what could happen? Well, you make a subtle adjustment, still 100% invest in the S&P. Well, now your diversified portfolio that I've been talking about, the reality portfolio that I'm talking about, that's a far cry better than trading the S&P 500. So that 14.88, call it 15% return, it don't look so good now, does it? So just looking at the risk metrics and looking specifically at a diversified portfolio, that's how much better a diversified portfolio can get for you. Let's look at 60 months further. Negative 3% for the S&P, that's not so bad, but you still had a 55% drawdown. Long only the S&P 500, I think diversification makes a little more sense here. So you can see throughout those numbers, the walk forward's not perfect, but I'd rather make 5% than lose 3%. I'd rather have a 10% drawdown than a 55% drawdown. And this doesn't take into account trading. This is just the markets. Obviously, we're here for trading, so we'll show some other things here. But it makes the point, why and how are you going to diversify? Here are some markets. Correlations, they help to determine this. The stability tells you where to look. Looking at these types of numbers, it only validates what it is that you can do. But I think it's important that you realize in real time that diversification, as we all know, as we should all know, is important. You'd be surprised how many people that I talk to that they say, I only want to trade the S&P. I don't understand one market. Well, live and die by that S&P. You might want to look at some other markets. That's the point. So step 2, that's all well and good, happy. How am I going to make some money? So in my previous life, I helped to run a software firm called Rena Systems. Rena Systems recently sold and put Portfolio Maestro into TradeStation. So a lot of the stuff that I'm going to show you right now is going to use Portfolio Maestro. Going to go quick, but I'm going to make the point that you want diversification not just through the markets, but you want diversification through your trading style as well. So the way I always look at it, and this is just a generalization, there's trend-based systems, there's momentum-based systems, there's pattern-based systems. You could add to that volatility-based systems, but those 3 categories will give you a pretty good feel. What time do we go to? What time? 3:15? 3:30. Okay. All right. So you take those strategies and you put them all together, and what you want to do is you want to start building a portfolio. So timing-wise, we're going to do just fine. Here is an equity curve, a VAMI, Value Added Market Index. It's an equity curve. The difference is I'm going to assume that I invest $1,000 into this particular investment as opposed to trying to worry about a lot of money management and things of that nature. It's basically a normalized equity curve. This equity curve is for a simple, very simple S&P portfolio that concentrates on the MACD indicator. Nothing magical. You get it inside of TradeStation. I'm not going to tell you how I did it because I'm a trader and I don't sell systems, but I'm just letting you know that there are systems that you can use, and there are indicators inside of TradeStation that you can develop. And this is an equity curve of lots of different MACD systems just on the S&P 500. Here is an underwater equity curve. Remember I was talking about pain and suffering? The yellow mark represents the maximum drawdown for these systems that trade against the S&P 500. You can see that the red, the prolonged red periods, that's when you're in a period of drawdown and then coming back out. Think of it as just a risk profile for the individual market. Point being where number one is. We'll show you how all these things come together in a second, but just note where number one is and where the maximum drawdown was for that particular S&P portfolio. VAMI again, in this case, this is for the euro. Same MACD systems, applied only to the euro on multiple time frames. And you can see that it's a pretty nice, steady equity curve. It's going to have pain and suffering. It was down in certain cases 10.5%. Or 10%, other cases 9.5%. But again, note, my number one disappeared, but there's you can see where the line is. That's the maximum drawdown. Go through this kind of quickly. Here's crude oil. Again, nice, steady equity curve. Again, the key, to developing a bigger portfolio. Lots of markets, lots of different types of systems. Again, note where the drawdown was for crude oil. That was a pretty hefty one, 40 some odd percent, 45%. But when you put in the mixture of a bigger portfolio, it again will make sense. Notice that there's a drawdown in each of these charts on the underwaters, and the most recent period, they're all hurting a little bit. Not exactly good for kind of trend-based, which is what MACD is. So there's no perfect scenario. Here's the equity curve for 10-year notes. That should be pretty steady. But even it's going to have some drawdown periods. 13.5%, note where that is, where that drawdown is. Gold, its drawdown is occurring right now, at least a couple months or about a month ago. Here is the equity curve for all of those 5 markets combined together, which is what the strength of Portfolio Maestro, what it can do. You can build these portfolios, as we just saw, for each of the 5 markets. Think of them as 5 separate baskets. Now, I want to take all 5 of those baskets across those 5 markets and bring them all together again. And this is the VAMI, or this is what the equity curve looks like for the portfolio. It has nice, steady, not dramatic drawdowns. It may look dramatic, but it's an 8%, 8.5% drawdown for the overall portfolio. And yes, all of the drawdowns are occurring at the same time, but on a relative basis, we saw a 40-some-odd% drawdown in crude oil in a portfolio. The maximum drawdown in this case, which is occurring essentially now because of some of the choppiness of the market, it's only 8%. I just want to make this point here that when you look at the ones which represent all of the individual markets, that they all occur at different times. Part of that is due to the way that the systems trade. Part of it is due to the way that we have non-correlated markets. So it's important that, in other words, all of the drawdowns are not all occurring at the same time. You trade the S&P, the Russell, the Dow, the NASDAQ, maybe the DAX, the CAC, the FTSE, the Hang Seng. They're all equity markets. Do you think that we're going to see drawdowns all at the same time? Do you think it makes sense to diversify and look at other markets and not to be a one-trick pony, to look at some other markets so you can take advantage? The obvious answer is yes. Question? Nope. These portfolios, and I should have mentioned that, they can go long and they can go short. So a diversified portfolio, a basket specifically for the S&P or crude oil, whatever the case is, you want to have a mixture of systems that can go long and systems that can go short, and you want to combine them together. This is one indicator. Variations of the same indicator making different types of systems, divergences, crosses of the zero. There's, I think, 4 or 5 different strategies, ways in which you can interpret MACD, go long, go short. Combining those together at the individual system level, and then again here at the portfolio level. So yes, they do go short. What I've also done is I've shown the second worst drawdown for the individual markets. And again, there's not really a lot of overlap. So the point is that diversification from a market perspective as well as a system level, it all comes together. So here is kind of the crescendo here where you can see the CAGR of 120%. There's a lot of things that are missing. Well, I had to, in order to normalize this, couldn't put commissions and slippage because I had to compare it back against the market itself. So these numbers are obviously inflated, but it makes the point that in each case, they're all normalized. So we have a CAGR of 120%, obviously bigger than any of the individual markets, and there's a synergy there. You can see specifically in the maximum drawdown that the maximum drawdown for the portfolio is less than any of the individual markets. That's diversification, my friends. CalMAR, sometimes called the MAR ratio, which looks at drawdown against CAGR. You can see that it goes up dramatically. More money, less risk. Obviously, that's what diversification is about. You do it at the market level, and you do it at the system level. You do the market first so you know which markets you want to trade. That guides you. You start with the market that you're most interested in, and then you build from there. What other markets are going to help me to diversify? That's the first part of the presentation. The second part of the presentation focuses on specifically designing systems, using your technical abilities. If you're discretionary, at least you know which markets to focus on. Here are some other ones, and I mentioned them at the very beginning, but here are some other markets legitimately. Cattle, I'm not going to trade cattle. Well, maybe you do. You've got corn, you got gold, you got a British pound. You've got a slew of markets there. Each one of those, based upon that correlation stability number that I showed earlier, these are the markets that you'd want to focus on. So you don't want to be a one-trick pony, in other words. That's the goal here. What markets to trade? There's plenty of them. Broaden your horizons. Look at all these different things. Design systems in something like TradeStation. Use Portfolio Meister to know what to focus on. Combine those individual baskets together, and what you'll end up with is probably, depends upon your skill level, probably something better than if you were only to trade a single market. I don't have time to pull this up because there were some other ones that we could actually look at. But you're welcome to give me a call. That's my cell phone number. You can call it right now and it would ring. I wouldn't answer, but you can call me. That's my email address. If you have any questions, email me. Skype, Twitter. I do a lot. A lot of the stuff that I'm talking about here in real time, I post it all the time. So if you like Twitter, go there. I forgot to put the, of course, I forgot to put the website. You see in my email address, it says capitalogics.com. That is the email, or that is the website. So if you go there, the correlation stability, the correlation matrix, some seasonal information, it's all up there. We do it free. I do it for myself so I can organize the information. So if I'm looking at it, you can look at it as well. And a lot of talking, we're out of time, but does anybody have any questions? The strategies that I was showing? No, they're strategies, they're systems where you're, in certain cases, in for a couple of days, stop loss, get out. Other times you're in trades for a couple of days, couple of weeks. As we mentioned before, you can go long, go short. These are systems that we use at our firm for a lot of different reasons to hedge, protect ourselves, to be able to invest in a diversified fashion. There's a question back here. Absolutely. What I would, obviously, when you look at it, correlations are easy to do in any program. Excel, TradeStation, whatever it is you're going to use. Key is, as I said before, use percent change data. Don't use price action. Percent change, period to period percent change. You do that, and everything that I just talked about, you can at least get an idea as to what the correlation is now. What has it been historically? How stable is it? How does that stability rank against other markets that I'd want to trade? Get together a list of markets that make sense to trade. Then start developing your systems for those markets, and then start combining them together. But you have to think in these terms. Use something like Portfolio Meister and the TradeStation platform, one, to test your systems, combine them together, so you take it step by step by step all the way through the process so you know, am I improving things, yes or no? And it's a fairly straightforward process. If you have questions after the conference, I'll be happy to answer your questions. Yes? Good question. Obviously, in the second part of the presentation, what we did was we wanted to combine those things to the buy signals for those different types of markets, be able to put them together. The first part of the presentation was there to say, listen, I only have so much money to trade. I can only follow so many markets. The key to the first part of the presentation is, what markets should I be focusing on? It'd be great to have 1,000 markets at my disposal, but reality says I don't have enough capital to trade it. So what you do is you select the first market that you feel most comfortable. Let's assume S&P. Well, now what you want to do is start building out more systems. Well, I could start building out systems for a lot of different markets, or I could use that correlation, that first part of that presentation, to say, or I could look at other markets that are non-correlated against the market I'm already trading, so I have a leg up. So at least the first market, the first additional market that I'm going to be trading is one that is going to have some of the diversification elements that I'm looking for. Of course, you could go short while the other one's going long, and you wouldn't need the correlation. However, I would much rather, in going through that period process of building a portfolio, I would much rather have those markets that offer up the type of diversification that I'm looking for, rather than just simply arbitrarily just picking different types of markets, yes, that go long and go short. To build an appropriate portfolio, at least bare minimum, do some form of correlation to find out, do they have a direct relationship or not? I could easily develop a portfolio that goes short the euro and goes long the S&P 500, and the correlation wouldn't affect me whatsoever. Exactly. So therefore, you want to have the stability of the individual markets as your starting point, so that you can effectively know which markets to design your systems for. It's the beginning. It's the quintessential starting point. What markets to trade? Start with one that you like. Figure out other ones that have non-correlation relative to that original. And obviously, there's going to be a weighting of those types of markets, and then begin the process of developing your systems to relate directly to those individual markets. It's a starting point. Could you just simply go long and short individual markets and skip that step? Of course. I wouldn't suggest it. I think that it's a well thought out process that gives you a leg up dealing with the appropriate markets before you start to develop the systems.